Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome to the Alt Goes Mainstream Going Public series with Glenn Schorr. In this special series, we aim to make private markets more public. We take a deep dive into the public side of the alternative asset management industry. Our guide, Glenn Schorr, is a well-known Wall Street analyst who has covered alternative asset managers since the first firms in the industry have gone public. Glenn is a senior managing director and senior research analyst at Evercore ISI. Glenn has covered the financial sector since 2000 as a senior analyst and has consistently been named to Institutional Investors All-America Research Team for his coverage of brokers, asset managers, and exchanges in large-cap banks, most recently ranking number 2 and runner-up respectively in the sectors in 2023 and number 1 and number 2 in 2022. Listen in as Glenn shares market stories, the evolution of alternative asset managers as businesses, the biggest and most exciting trends in private markets based on what the industry's largest players are doing, and we also will go around the horn for his analysis on each of the publicly traded firms. Couldn't ask for anyone better to take us on this journey. Glenn and I hope you enjoy.
We're going mainstream.
Glenn, welcome back to Going Public. I want to start with Wu-Tang Clan. So you quoted Wu-Tang Clan in one of your recent reports. Tell us more about that.
Well, I'm an old school hip hop guy, so everything either goes back to old school hip hop or sports or pop culture for whatever reason. So they had a great song back in 1993 called C.R.E.A.M, which stood for Cash Rules Everything Around Me. And so, I don't know, the asset managers, cash rules everything around them. In this case, sure, it's capital raising, it's fundraising, and those raising the most are in the best position to capitalize, sure. But some of these companies have a ton of dry powder, and that means future earnings in tow. That's future management fees as they deploy it, that's future capital markets fees. So sure, the asset management industry, cream.
So you called it, in this case, F.R.E.A.M. So fees rule everything around me. Let's unpack that a little bit more. What do you mean by that?
When you look at how the public investors value these companies, there's a bunch of different revenue streams, and the public investors will value some streams higher than others. And so as we talked about last time, the evolution of these companies as public entities, the management teams got that they needed to be C Corps and not publicly traded partnerships. The management teams got that people highly value fees and not as highly value the carry, though they do value it. Same thing with capital markets fees and then the duration and durability of the capital. So everything comes back to incentives and what the public investors want, and these management teams have adapted along the way to get them there. And bottom line is you want to see fee growth. Some of these companies had, one for instance, stands off the top of my head, at 35% F.R.E.A.M growth, except some of that was manufactured through some comp changes. Their management fees were up like 2%.
So maybe it's a little spicy to talk about this, but I want to get into this, which is how do firms balance fee growth, fee-related earnings, with the returns on their investment products? And how should investors looking at one or both, and maybe in some cases they can invest in both the stock and the funds, how should they think about both of those things? And how do the managers themselves think about those things?
It would sound like a canned answer, but I do believe asset managers wake up every day hoping to do right by their client and execute on the investment thesis and strategy that they were being paid to do. Whether they generate alpha every day and hit those targets, different story. The world's a tough place. We talked about last time in the traditional asset manager space, they used to crush the targets, and then all of a sudden there were more mutual funds than there are stocks, and then underperformance, and then fees come down, end of story. I hope we don't visit that, that past in the future for this space, but we probably will. So you're trying to generate alpha. You're trying, my homage to Mark Rowan with my blue sweater. You're trying to generate alpha for each incremental unit of risk taken. And in this space, there's been a lot of alpha generated over time. I remember BlackRock, as they were evolving in the space, they have the concept, and I agree with them. Your fees should be in line with the potential alpha that you can create. So if you're in an ETF and you're trying to replicate an index with small margin of error, well, you should probably be charging a small fee for that. And if you're in an opportunistic fund with the potential to generate a lot of alpha, you can charge high fees. And clients will stop giving you money if you don't generate the alpha. And life is simple that way.
Well, it gets to another really interesting and important point, which is the talent side of this. If you want to attract the best talent, you have to pay for that talent.
Mm-hmm.
So that, in some senses, maybe that justifies the fees.
You could charge whatever you want if the alpha generation is consistent and offsets it. Yeah, I do think in every industry I cover in financial services, talent, your R&D and your talent walks in and out the door every day, and it's a competitive world. You're seeing talent migration right now on the private credit side coming from the public markets. If you're a good lender with real relationships and the ability to generate high quality, originate assets, you could work at a bank like you have in the past. But when the alts come knocking and say, hey, how would you like to leave that big regulated bank with a salary bonus structure and come over to this new world of private markets? There's a lot of migration of people, talent, and capital migrating over to the private markets.
So you just opened the door for another topic that I think is really important, particularly in today's environment post-election, where presumably there will be some level of deregulation or less regulation on banks. Prior to the election, alternative asset managers seem to have much more of a free run at the world of private credit in particular because banks are regulated. If banks become less regulated in a new political and economic regime, what does that do to alt managers?
I believe there will be a lighter regulatory touch in the next administration, but we're not fully reversing, going the other way. In other words, let's start out with the foundation of what brought half or so of the middle market lending world from public to private markets. Some of it is just flexibility, immediacy, certainty. It's not, oh, I'll price you at SOFR plus 500, but I have flex pricing. So in 6 months when that deal closes, if the markets are messed up, it might be SOFR plus 1,000. I don't know. We'll see. So knowing what your cost of capital is, having a single or small group of lenders to negotiate with terms, flexibility, and then work out if and when you ever need support along the way. There's some things that make a lot of sense that whatever regulation is, those benefits will go on. And then just if you own the origination, put it this way: when Atlas was owned by public company Credit Suisse, that was originating $50 billion or so in annual loans, asset-backed loans, to a public company from a public company in debt land. And now, before their demise, they sold it to Apollo. And now Apollo originates it and puts it into their private credit vehicles and insurance balance sheet. And so there's deregulation can help in a bunch of ways that we can help the banks. But, we've witnessed a bunch of things, even in the last 2 years on the liquidity front, that banks have overnight funding for deposits. They make longer duration loans with a mismatch, and they do it on 10 times leverage. Let's be careful on how much we want to deregulate.
So that's a structural challenge for banks that they won't be able to get around, in your mind.
Correct. Like I said, I do believe that there will be benefits, and you've seen the stock market vote with its feet lately. There'll be benefits to the industry of a lighter regulatory touch. I just don't think it can stop this trend from public to private, people-wise, capital-wise. origination wise.
I want to touch on that. That gets to the topic of growth. And let's pay homage to Mark Rowe and the sweater that you're wearing. But he said this about Apollo recently, which is that I think the growth of their firm was greater than software companies. I think since 2007 they grew 15 times, which was faster than Microsoft's growth and other tech companies. Are we still in a period of growth like that for alternatives managers?
My answer is yes. I want to make sure I just answer it up front. Now I want to give you a little context of this quarter. We saw some slowing of the growth in insurance-related earnings because interest rates have come down, spreads have tightened some, and that impacts spread-related earnings for Apollo and other companies that have insurance business like KKR and others. Don't mistake cyclicality for structural growth. We have structural growth ahead. I'll give a tiny flavor of, let's throw some numbers at it. There's about 140 trillion in institutional assets across pension plans, sovereign wealth funds, endowments that have like nice size allocations of 20 and 30+% endowments. Some are up to 50% into private markets. And they're allocating more because there's more flavors, more asset classes within private credit. I mean, more asset classes across private markets. I mean, infrastructure kind of gets thrown into private equity. Secondaries gets thrown into private equity. Infrastructure debt, real estate debt, that's just all private credit, not the different flavors that are emerging here. I can go on and on. There will be separate sleeves and separate allocations in some cases, and higher allocations just in the 140 trillion or so that already was believers and had been investing in this space. And then depending on which estimate you look at, there's somewhere anywhere between 85 and the same 140 trillion on the wealth side of the bucket that has 1 and 2 and 3% allocations that is just getting started with some of these strategies. So there's a lot of growth ahead.
So the bull case is obviously that the wealth channel is a massive driver of growth. Is there a world as you look out a few years on the horizon where wealth channel growth, I think we probably both believe that there's a lot of it to come, but just take a little bit more of a sanguine view. Like, is there a world where that doesn't happen to the extent that the industry might think it will?
Like you said, we both feel like it's a unstoppable train. But like I think about this all the time. Again, why would anyone on the planet pay really high fees and lock up their liquidity, lock up their money for a long period of time? Well, you better get the non-correlated returns that help you build a durable portfolio. But more importantly, you better get better returns than I can get in an ETF or somewhere in the public markets. And so I have discussions. You look at the last couple of years. In 2022, the stock market went down 20% in the United States, and private equity was flattish. Now, did they mark? Did they not mark? Whatever. In 2023, public markets went up 20%. I didn't hear anybody screaming that private equity was only up 2%. So there's some balances in there. 2024 comes along, the market's up, 26 or more percent, and private equity is up single digits. So that's actually still a small sample in time. So you could say, hey, for the last 3 years, it's underperformed public markets. The private equity game's over. Doubt it. I do think we have some challenges with all this dry powder and the concentration in the public markets, and now what we've seen post-election. But over long periods of time, the private markets have to create alpha, or they won't grow like you think. And I do believe, last thing, in the wealth management world, if you're an FA and or one of their clients and you're crushing it in the S&P or NVIDIA, why do you want to go through these complex illiquid products? So I believe great markets can slow growth. But we'll see. If interest rates come down, that could be a boon for private credit again, which gets you safe, comfortable yields, and you're not buying stocks at 100 times earnings.
Brings up a really interesting question, which is, have you observed a mindset shift within the wealth channel investor in terms of what you just discussed, which was okay, yes, on a 1, 2, 3-year time horizon, maybe public markets in a certain market regime or interest rate environment outperform. But are investors in the wealth channel now thinking about things on a 10-year time horizon? Because if you think about it on a 10-year time horizon, then what you said about over a longer period of time, private equity may outperform, maybe less volatile, and we can debate that and why, but that if you think about things over a long time frame, then having some private markets exposure may make sense as a complement to public markets exposure.
Well, you hit on something very important. These strategies, these products across the different asset classes within private markets, they should be being sold as an allocation and a not liquid allocation of a client's portfolio. That's the way some big sovereign wealth fund or public pension plan thinks about it. They have long dated liabilities. They get long dated assets that pick up better return for give up liquidity. You don't need liquidity when you have 30 and 40-year liabilities. Well, that's what any individual should think of it as. That's an education process. It's early days and it's in motion. However, on any given day, the FA and or their client is thinking to herself or himself, I mean, I'm killing it with what we got. Do I need to go in and try to sell this now? And I'm sure, put it this way, I think we've had the first couple of perpetual private equity products in the wealth channel right now as we speak, with BXPE at Blackstone, with KPAC at KKR, and everybody and their mother has one coming next year. So it's going to get crowded pretty quick. And sales have been nice, and $1 billion here and $2 billion there. And these things will compound, and there are incredibly profitable products for the companies. And I think they will be great for the individual investors. But my gut is there's no huge hurry, because there's no way private markets can keep pace when you have a runaway train. Now, do you think you're going to have a runaway train forever? Is the market going to trade at 30 times forever? Like, there will be hiccups along the way, and private markets will come in and reset, and there'll be great vintages. And let's not forget about all the dry powder that's out there to take advantage of those.
One sub bullet to what you just said about the wealth channel adopting private markets is a more recent trend of creating model portfolios. So one example of that, BlackRock Partners Group have recently partnered on a model portfolio. What do you make of that as the way? Because you said something really important in your last comment, which is people need to think about it as an allocation to private markets. Is model portfolios, is that the next frontier for private markets allocations, where you're making it easy for FAs, and that's where you start to get real size and scale of allocations from the wealth channel?
I think so. Not everybody, because some FAs like to control the dial but I absolutely believe that BlackRock's ETF business was awesome, and it got awesomer through the delivery of model portfolios. And we're numb to it because there's this tidal wave of money that just kind of shows up every quarter. It's volatile. It has cyclicality to it, but like, my Lord, the numbers, they add a ginormous asset manager every quarter just through the ETFs and the model portfolios that are helping that. And so, sure, I do believe in the nirvana of, well, if we have a piece of this model portfolio that just by coincidence points to a lot of iShares ETFs, that has a piece that is a private markets fund that actually delivers you all parts of asset classes between BlackRock and partners, a sleeve, sure, that can drip in. Let's make believe that was a 10% allocation into the model. 10% of really big numbers is a big number, right? I'm good at math. So that can make its way in. And I think that's where their pole position in their models and on their desktop space and in their relationship in the wealth channel can really work. And that was the most interesting thing that not everybody fully embraced when that announcement came out.
How many firms can do that?
Can I add one word at the end of it? How many firms can do that in size and scale and well and really benefit? Because because if I answer your question, it's like, I don't know, everybody could probably say they can do that. But can you get in the model?
And it's not just getting in the model, but, and there are certainly other firms out there, but if you think about it, BlackRock has an SMA business. They have a model business, and they have the software. They have Aladdin, right? They have the desktop real estate with the advisors. So that's where I'm kind of going with this. Sure, there are other firms who do TAMPs, that do SMAs. There's others who've done models, but like, how does this whole model world evolve? And is it like the traditional asset managers who win? Is it did the alt managers try to couple up, but then there's only a certain number of chairs left at the dance, and you got to get in quick and early?
This reminds me of when the trading of equities and then eventually fixed income started to trade electronically in the early 2000s. And then every investment bank would have their own algos that were better algo than that company's algo. But eventually, how many algos do you need? How many ECNs do you need? How many trading venues do you need? And so I do think first mover and size and relationships and partnerships, all that stuff matters. And right now, BlackRock has a great lead. Now, I'll throw a little monkey wrench in there and say, distribution almost always wins in asset management. Now, I'm not saying that these manufacturers I cover aren't winning, because they're winning huge. There's long road ahead. There's a lot of money to shift from public to private. They get paid big fees. The money's locked up. They're winning plenty. They have 60 and 70% margins. It's insane. But the distributor has end clients' money. And when there eventually were more mutual funds than there were stocks, what do you think happened? Distributor kept winning, manufacturer, fewer kept winning. So I do believe that the size, scale, breadth of products, all those things actually matter. And I think to be important to the big distributor, you have to be able to do a lot for them. We can talk about that. And so I don't want to lose out, because on this topic, what are the chances one of these days that all the big distributors don't wake up one at a time all at once and say, I don't know, maybe we should run the models ourselves. Maybe we can be running this and we just put products. And maybe we need a breadth of product with open architecture. And maybe we like this private markets fund, but we also like this private markets fund. Like there's a little healthy tension to that.
So F.R.E.A.M rules the world, but also the distributors do?
Yeah, they rule the world. It's like my house. I rule my house as long as my wife says I get to rule my house, right? Like, I think distribution always wins, just like Cheryl always wins.
Do you think the distributors understand that?
1,000,000,000%. And they understand that they're partners with these companies. All right, let's go through some numbers. If Morgan Stanley is the largest distributor in the wealth community in the world of alternative assets, and they're huge at 5 or 6%, if you include all the dry powder as allocated, of their 6 trillion growing to hopefully 10 trillion of client assets, they absolutely believe and want to take their client allocations to 10 and 15%, so double and triple the current size. I love my neighbor Mike. He's in the industry. He works at a really, really good single vintage private equity fund of like, say, 4 billion. Neighbor Mike is amazing, but he can't help Morgan Stanley get another 500 to $1 trillion of private assets allocations over the next 10 years. So they need their big scaled, well-funded and broad diversified partners to get them there.
Okay, so I want to unpack two things in there, because I think there's major implications for the industry if that's the case. I'm going to start with the largest scaled managers. So we talked about the distributors and said that they understand this dynamic and that they rule the world. What are the large alternative asset managers doing on the corporate strategy side to say, okay, maybe we need to partner with these distributors, we need to get in the models? Are all those large alternative asset managers, are they keyed in on what they need to do to get in the models or live in this, if it is a true new market structure regime, is that Is that something they're all fully aware of as they think about what goes forward?
I think their left pinkies are smarter than I'll ever be, right? So I think they're keyed on everything. The question is, what can you execute on, and what's realistic, and then the unfortunate for them healthy tension of being a public company. You don't get to act private every day, even though that's always been easier said than done, but it would be smart to act private always. Problem is you have a public currency that's going up and down, and you got to deliver margin, you got to be managed expenses, because in the perfect world, you'd be great in every asset class in private markets. But how do you get there? Because KKR, I love to talk about them as the 10-year overnight success story. They just methodically built infrastructure from the ground up and hit their third and fourth vintage. And you blink your eyes and they turned a few billion into like 80 billion, close to 80 billion. And they did the same thing in real estate. And it's incredible in Asia over the last 30 years. And so you look at them now and you're like, oh my God, they're just growing everywhere. Why can't you be more like KKR? Okay, so if you're newer, are you willing to spend the money and take the time and be patient and do it organically over the next 10 years? Or a company that I really like, Blue Owl, who's great in direct lending, the best in GP stakes, has a great triple net lease business, and that's it? And be like, well, there's a whole lot of other stuff growing. Do we want to wait 10 years or screw it? Let's buy 4 companies in the last 8 months and let's go for growth, because actually we have what those companies need. We have distribution and product know-how and structuring and a brand, and we can help them take their business to the next level, just like they did with that triple net lease business. They almost tripled it in 3 years. So different strokes for different folks, and you have to figure out what you can execute on, what you're willing to do, what you can afford to fund now.
So I imagine the best corporate strategy people are not just thinking about the competitors they know, but they're thinking about the competitors that may come from unknown vectors. And maybe the private firms are not necessarily competitors from unknown vectors, but they're not in the same boat, so to speak, as their publicly traded peers, if you're a publicly traded manager. But to your point, privately held firm can do things in a bit more nimble fashion. Do you think those firms will be the ones, and maybe at some point they will go public, and maybe they move the right chess pieces on the board that'll enable them to have some real advantages? But to your point, the last comment about some of these firms thinking about partnerships with distributors or things like that, are there a class of privately held firms who are also big enough? A lot of them are probably in Blue Owl's portfolio on the GP stake side, right? Because they show the ambition. But in your mind, is there a bucket of firms there who are really thinking strategically about, okay, what can I do?
Eventually, being public, there's multiple advantages that offset the huge disadvantage of having to talk to me. Having a public currency is certainty. Yes, like every other company that I cover, it gives you ability to attract and retain and use stock. But one of the companies I cover, we talked about it last time, TPG was looking to find a partner to build out in private credit, and they found someone that, they loved each other and they wanted to get hitched. Yeah. Well, before that, the conversation was like, okay, we love you. We'll give you X% of our company. And they're like, well, we love you too, but how'd you get that price? And I'm like, well, we think we're worth this much. And we're like, really? Because we thought you were worth that. And so when you're public, I should say, you're worth what the market says you're worth. So having the public currency, if you're one of those that wants to build and get out, I am sure Blue Owl had, I don't want to call it easy, but an easier time, less difficult time buying those 4 things that they just bought, 5 if you count their Oak Street, having a nice, highly valued public currency, because the world says every day, I know what you're worth. And so different companies have different ambitions. You could, again, I love using Neighbor Mike as an example. Neighbor Mike and his company can sell their company to anyone on the planet at a huge price, but they're all young. They love what they're doing. They're printing amazing returns, and they're methodically building their business, and they're not trying to grow every asset class out because the iron's hot, and some companies want to do that.
So what happens to neighbor Mike, $4 billion, even $10 billion private equity or alternative asset manager that may want to grow, but may not want to grow to the same extent of a Blue Owl and get to 100+ billion, few hundred billion, et cetera? Like, what happens? We talked about the larger firms, both public, private. What happens to the smaller firms, especially as more capital comes in from the wealth channel, which I think we established is it will probably trickle down to the smaller firms too, but most of that's going to go to the large alternative asset managers and brands because that's where the distribution relationships are. So what happens to the smaller firms?
By the way, we can have this discussion about what happens to the mid-sized firms too, because in a lot of industries I follow, the barbell still works. Neighbor Mike can sell himself for the history of time as long as his performance holds to anybody. They have a unique expertise in their vertical, and anyone would take them any day, and they keep putting up returns, and they're growing. So specialty managers are doing just fine, more than just fine. The interesting thing is, if you look at Blue Owl's last handful of acquisitions, they all look the same. Quality manager in a specific vertical, let's overgeneralize and say about 10 billion of AUM, that could have been fine for a long time, except they said, if we want to get bigger, broader, and or monetize what we've built while still keep doing what we do, maybe we attach on to someone, because if we think wealth is half as good as Glenn and Michael think it is, well, it's too late to build a brand. It's too late to build out that distribution platform and be relevant to the channel. Blue Owl doesn't have anything in asset-backed finance. Blue Owl doesn't have anything in real estate debt. Blue Owl didn't have any, right? And in data warehouses, right? And so attach on, build, and so there's different models. And no, you don't have to be public. You don't have to be a $1 trillion manager. You could be happy doing what you do. Eventually, if you're public, the evils of buy and sell side pressure will want you to manage your margin, will want you to grow every quarter or every year. And that's the healthy tension of public versus private.
What happens in the near term in that regard? Are there specific categories or strategies or sub-asset classes where you're hearing that managers want to buy? You mentioned a few, like data centers. That obviously seems like a really interesting space. Blue Owl acquired IPI as one example. Asset-backed finance, Adelia, it seems like other firms. Monroe, obviously, also Victory Park, got bought by Janus. Are there specific areas where you're hearing these are interesting categories and spaces for larger firms to acquire specialty managers and categories?
No doubt about it. You definitely just touched on a bunch of them. But you go towards the big TAMs. If you want to invest in a space, I wouldn't invest too much money on 57-year-old, mostly bald Jewish guys that can't jump, making it to the NBA. Like, that's probably not the best investment. However, if we saw, let's call it 50% of the middle market lending world over time transition from bank lending to private credit lending, and then you look at the asset-backed finance world, which is somewhere between 2, 3, and 4 times larger, depending on what you count, migrating over to the private markets. And then numbers that I can barely comprehend of $75 to $100 trillion needed to be spent on infrastructure and energy transition, including those data warehouses, to power AI, to make sure we save the planet, right? Like, you can't put those in deposit-led banks. You can't put those in overnight deposit mutual funds. They have to be the longest duration asset pools you can find. And so, yeah, it's not that surprising that the managers say, well, I don't know how to build a data warehouse, but I know that we're going to need a lot of data warehouses. There's only literally a handful of people that have built these things. All right, Blackstone got a bunch of them. KKR got some. Blue Owl just got one, right? So, and the numbers come in tens of billions at a time. The numbers are huge. So yes, data warehouses and AI, energy transition, asset-backed finance, the big TAMs, the wealth channel, the insurance market, right? This is where you've seen acquisitions. And that, by the way, that's one of the takes, not just of the quarter, but of recent times, is it's in the history of asset management, of me following it, when things were great, most great asset managers don't want to sell themselves. The mediocre asset managers had 30-something% margins and a lot of growth. Why sell, right? Unless you have an aging founder that wants to transition, and there's always things like that. But they're usually not selling when everything's amazing. Right now, you're seeing some companies sell when everything's amazing with huge TAMs ahead because they're not sure if they can tap that growth themselves. That's what I think. That's the positive view of some of these deals.
So you've been in the industry for a while, not to age you, but you've seen a lot.
I'm old.
You probably get a gut feel of what kind of time it is. Like, is it a period of consolidation? Is it a period of slower growth? All those things. Do you feel like now is a relative to other times, this is a period of consolidation for the alternative asset management industry?
There's no doubt. And mind you, it always takes two, right? And I think there are thousands maybe of these managers, and the overwhelming majority probably don't want to sell, just so we're clear. But we are definitely in consolidation time. If your aspirations are to be able to get a bigger share of these TAMs or be a part of a bigger, broader, or if you want to tap the wealth management market, it depends on what you're trying to accomplish. And so I do think there are more that say, wow, that wealth space is as big as the institutional space with a lot less penetration, and they want what we got. You have to hit your moment in time, right? It's like right now. All of a sudden, I'm cool again. Like, people want to talk to financial analysts because, somebody won the presidency. Like, strike while the iron's hot, and because we're cyclical and it won't be that way forever. This is different. This is, can I tap that structural growth? And do I need to be part of something else? Do I need to be public? Do I need to be part of something else? Do I need to be partners? Because with some other asset manager, because they have what we have. BlackRock would have loved to have done that product themselves, but they can't because they don't have everything that they need for that. So do it as a best in breed with partners and then deliver that through your model. Great. But you're seeing plenty more of that. Traditional managers want to diversify away from the shrinking stuff and get into the growing stuff. They're buying whoever will sell to them. BlackRock trying to transition their business. They're not done buying things in the alternatives in the private market space. And then as Blue Owl and others will want to fill in verticals that they don't have. But again, you need a seller to have a deal.
Let's go around the horn.
Sure.
This past quarter, obviously in recent weeks, the alternative asset managers as a whole did really well. I think that's part of a broader, financials, banks did really well too recently in public markets. What were some of the most surprising things that you saw from the quarter, least surprising things?
Okay, let's do least first, because there's less of them and they're obvious, so we can glance through that. Okay, least surprising is there's limited fundraising still in private equity and real estate. There's still these ongoing indigestion problems or lack of interest issues that we've touched on, or interest rate related. No, that's least surprising. Someone puts up flat returns for the year in real estate. You're like, oh, well, moving on. Meanwhile, that stinks in the grand scheme of things. It's just, but it's 1 year. Performance not matching the public markets. Also not surprising. Not good long term. Just 1 quarter, just 1 year, but also not surprising. And then increasing M&A expectations around the world. And that was happening way before the election, but the election put it over the top because apparently everybody doesn't have to have price protection on coach pocketbooks. So those were some of the least surprising things. There were actually plenty of surprises, to different degrees surprises. I would say deployment is a pleasant surprise. There's a lot of money being put to work. there's an insatiable demand for investment grade private credit. So insurance companies are growing and they want to be fed, and there's wider spread product in private investment grade than public investment grade as credit spreads tighten. That's one thing.
I want to just hang on to that for 1 second. On the other side of that, though, LPs are locking up their capital and they don't necessarily know when or where the credit cycle will land. Are they, yes, I understand why they want to allocate now and deploy now. Are they concerned about the other side of this?
Based on the flow of capital, I would never say no, they're not concerned. I think it's been a long time since we saw a proper credit cycle. It's a when, not if, but we might have just gotten a reprieve. Yeah, that's an economic comment of like, this is the no landing scenario is kind of playing out, that like rates might not go down as much as we thought just a little while ago because the economy's kind of still humming in that 2-3% growth range. So they're not worried, but they're not going to sit in cash. They're trying to buy investment grade assets with spread and get a little excess return over public markets. So credit people are always nervous. Credit people always think the end of the world is around the corner.
We want them to. That's They should.
You touched on data centers, but the size of the investment, like, I mean, you know, and a lot of it's aspirational. Like when Blackstone and Microsoft and others say, yeah, we got $30 billion fund for data centers. Like, you know, like, where's the money? What are you building? It will be put to work. KKR, $50 billion.
Similar to C.R.E.A.M, it's like size really matters in this space. There's only a certain number of firms that can actually do what you just said.
I am so glad you brought that up. It's one of the many things I hope we talk about. I want to circle back to some more surprises after. Let's talk about size for a second. In asset management, eventually size was always a bad thing. You got so big, you can't outperform, you can't find alpha, and eventually, and if you look at small cap funds, for example, I covered a lot of asset managers that manage small cap mutual funds, and I very much respect these managers. I remember many times when T. Rowe Price would close to new investors their small cap funds because they want to protect performance, do the right thing by shareholders, allow current shareholders to put more money in, but close to new shareholders to limit capacity and to be able to keep creating alpha. That's a great manager. That's not an asset gathering, money hungry fiend. That is someone that's trying to do right by their client. And that makes sense in small cap land because it has a mandate. Small cap used to be like 3 billion. Now it's like, I don't know, 10, but whatever. They would try to protect that, but there was a limited audience, a pond that you can play in. It's like when I go fishing, there has to be a size limitation. You can't keep a bunch of shorties. So what's interesting in private markets, I do think size is always going to be ultimately have some impact, but wow, there are a lot of ways that size is helping these alternative asset managers right now. So it was a while ago, but when GE, this was the first time that it really punched me in the face. When GE had to get rid of GE Capital, which had, I don't know, let's call it $30+ billion of real estate assets at the time. Like, who the hell can buy 30 billion of real estate assets? One phone call is what it took. Hello, Blackstone? Boom, right? So size got you that look. Did GE want to call 13 different asset managers to club up and piece together and bid on a portfolio where they each get, 9%? Like, not a chance. So size can bring you deals of size that others can't do. Even with Blue Owl, if they're the largest GP stakes firm and a large manager wanted to sell 15% right now, and that means you need a check for a billion or $1.5 billion, you can't have it be half your fund. So you have one phone call to make.
I think that's such an important point when it comes to managers' edge. Like, that is a real edge. Sure. Like, you can argue capital flowing into a space, the more capital that flows in, potentially there's return degradation. But there have been other people on my show, former CFO Blackstone, Lawrence Tosi. He said exactly what you said, which is there's areas of private markets where size does give you an advantage.
If you want to penetrate the wealth channel, help Morgan Stanley triple their assets and size. Neighbor Mike doing it? Sorry, Mike. It's going to be the big, well-funded firms that have a lot of footprint. If you want to be Citigroup's partner and take down 25 plus billion over the next 5 years of M&A loans, I don't know, you got to have a pretty big place to go place that. Hello, Apollo, right? Energy infrastructure transition, like there's constant. And then we didn't touch on it, but here, one of the other surprises in the quarter, I wrote a note 2 weeks ago called Co-opetition Works. There's the dozen of these bank and alternative asset manager partnerships, and then a bunch of these block transactions with forward flow agreements. You can't, if you're Barclays and you sell 1.1 billion of your $14 billion credit card portfolio to Blackstone, and you're testing the waters to see if you should offload the other 13, these are big transactions. If you're Intel and you do that $11 billion, take on $11 billion investment to take down half your Fab 34 facility in Ireland, who are you going to turn to for that? You're not turning to a club, you turn to one. And so Apollo, there's countless examples of this space. While we're in growth mode, while we're in secular growth and transition from private to public to private, size is a positive, not a negative.
So to wrap this up, what are you looking for next quarter?
I'm looking for proof points, meaning every bank and broker I cover, also the alternative managers, will tell you these are early days of a multi-year improvement in M&A, and it's go time for exits, and it's go time for monetizations. Whether or not you're getting positive gains from your marks, be damned, the LPs want their money back. We need to transition this vintage. We need to return money back to LPs. You want to see that that's still happening. It would be nice to see some IPOs and not just M&A, but I'll take an exit how you get it. You want to see asset-backed finance continue to transition. You want to see F.R.E.A.M ramp higher. And you want to see capital raising, even though the S&P just goes up every day.
All right. Going public, Glenn. We'll be back next quarter.
All right. Awesome. Thanks,
Great
Mike.
to have you. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're